Hello and welcome to Mastering Finance with Dean Tellone. I'm Dean Tellone, and I'm excited to guide you through episode 13, Understanding Capital Gains and How They Affect Your Investments. In today's episode, we're going to demystify capital gains, a topic that affects nearly every investor. Taxes on your investment profits can significantly impact your returns, so understanding capital gains is crucial for both new and seasoned investors. In this episode, we'll break down capital gains in a clear, conversational way. We'll cover what capital gains are and when they occur, in simple terms, so you know exactly what triggers a taxable gain. Short-term versus long-term capital gains, the key differences in holding period and why it matters for your taxes in the U.S. Tax rates and income levels, how capital gains tax rates work, 0%, 15%, 20%, etc., and how your income influences what you pay, which assets are subject to capital gains tax, from stocks and bonds to real estate, crypto, and even collectibles. Capital losses and tax loss harvesting, using losses to offset gains, including the $3,000 rule and carrying losses forward. Special cases and exemptions, like the primary residence exclusion when selling your home, and 1031 exchanges for real estate investments. Smart strategies to minimize capital gains taxes. Real-world tips to keep more of your investment profits in your pocket. Throughout the episode, I'll also share real-world examples, such as an investor selling an appreciated stock, someone selling their home, or rebalancing a portfolio, to illustrate how capital gains taxes come into play in everyday financial decisions. My goal is to explain these concepts in a straightforward way, so whether you're a novice investor or a seasoned pro, you'll gain some valuable insights. So grab a cup of coffee, get comfortable, and let's dive into understanding capital gains and how they affect your investments. Core concepts. What are capital gains? Let's start with the basics. What exactly is a capital gain? In simple terms, a capital gain is the profit you earn when you sell a capital asset for more than you paid for it. A capital asset is just a fancy term for almost anything you own for investment or personal purposes. This includes things like stocks, bonds, real estate, your business, or even personal items like jewelry or a car IRS. If you buy something and later sell it at a higher price, the difference is your capital gain. If you sell for less than you paid, you have a capital loss. For example, if you bought shares of a stock for $1,000 and later sold them for $1,500, you'd have a $500 capital gain. Conversely, if you sold for $800, you'd have a $200 capital loss. When do capital gains happen? Importantly, a capital gain or loss is only realized when you actually sell the asset. If the value of your asset has gone up, but you continue to hold it, what we call an unrealized gain, you generally do not owe any tax yet. The tax is imposed once the gain is realized by a sale. In other words, stock shares or any other investment won't incur capital gains tax until they're sold, no matter how much they've increased in value on paper. This is why you might hear the advice, defer selling if you want to defer taxes. The timing of when you sell an asset is a critical factor in tax planning. Capital gains versus ordinary income. Keep in mind that capital gains are considered different from ordinary income, like your wages or interest income. They have their own tax rules and rates, which are often more favorable for long-term investments. We'll get into the specifics of tax rates shortly. The government does this to encourage long-term investing and to account for inflation and the risk investors take on. But not all gains are treated equally, which brings us to the concept of short-term versus long-term capital gains. Before we move on, one more core concept: capital losses. Just as you can have gains, you can also have losses when an investment's value drops. Capital losses can actually be useful at tax time because they can offset your gains, reducing the amount of profit that's taxed. We'll explore this more in depth later, especially the strategy called tax loss harvesting. But for now, remember, if you sell an investment for less than what you paid, that loss can often help cancel out some of your other taxable gains. However, note that losses on personal use property, like your personal car or home, typically cannot be deducted for tax purposes. Tax rules usually only let you use investment losses to offset investment gains or a limited amount of regular income. Now that we know what capital gains and losses are, let's talk about the different types of capital gains and why the length of time you hold an asset matters so much. Core concepts: short-term versus long-term capital gains. Not all gains are taxed the same. The taxman cares how long you owned the asset before selling it. In U.S. tax law, there are two main categories: short-term capital gains and long-term capital gains. Short-term capital gains occur when you sell an asset that you owned for 1 year or less, 365 days or less. Essentially, if you buy and sell within a year, any profit is short-term. Long-term capital gains are for assets you held for more than 1 year before selling. So if you held on to that stock or property for over a year, at least 366 days, the profit when you sell is considered long-term. This distinction is crucial because it determines how the gain is taxed. Short-term gains are taxed at your ordinary income tax rates, which are the same rates you pay on your salary, bonuses, or interest income. These rates are based on your income and can range from 10% to 37%, the top federal income tax bracket for high earners. In other words, a short-term gain is treated just like additional salary for tax purposes. And since most people's income tax rate is higher than the special capital gains rates, short-term gains typically face a higher tax burden. On the other hand, long-term capital gains are taxed at special preferential rates that are usually lower than ordinary income rates. For most individuals in the U.S., long-term capital gains are taxed in one of three brackets: 0%, 15%, or 20%, depending on your total taxable income for the year. Yes, you heard that right. In some cases, you might pay 0% tax on long-term capital gains if your income is below a certain threshold. This is a huge advantage of long-term investing. The majority of middle-income investors fall into the 15% long-term capital gains bracket, and the wealthiest investors might pay 20%. These rates are part of the U.S. tax code's incentive for people to invest for the long haul, to give a sense of the income levels. For the 2025 tax year, a married couple filing jointly can have roughly up to approximately $94,000 of taxable income and pay 0% on their long-term capital gains in that range. Many households will pay 15% on long-term gains, and only very high incomes into the hundreds of thousands of dollars hit the 20% rate. Exact dollar brackets adjust each year for inflation, but the concept remains: low income equals 0% rate, middle income equals 15%, high income equals 20% on long-term gains. By contrast, if those same gains were short-term, they'd simply be taxed at whatever your ordinary income rate is, which could be, say, 22% or 24% or higher, depending on your tax bracket. Clearly, holding investments for over a year can potentially cut your federal tax rate on the profit significantly. Let me also mention a couple of special cases in capital gains taxation: collectibles and certain small business stock. Long-term gains on things like Collectibles, art, coins, precious metals, etc., and certain types of small business stock don't get the standard 20% cap. They can be taxed at higher rates. For example, long-term gains on collectibles can be taxed up to 28%, and certain qualified small business stock gains up to 28% as well. Real estate that has depreciation recapture, like if you claim depreciation on a rental property and then sold it, can have a portion of gain taxed at a maximum 25% rate. These are nuances most everyday investors might not encounter often, but it's good to be aware that the 0 to 15 to 20% structure has a few exceptions for specific asset types. Net investment income tax, NIIT. If you're a high-income earner, the U.S. also imposes an additional 3.8% net investment income tax on top of your capital gains tax. This kicks in for individuals with modified adjusted gross incomes above $200,000 or $250,000 for married couples, and applies to investment income, including capital gains. In practical terms, this means some high earners might effectively pay 18.8% or 23.8% on their long-term gains, 15% plus 3.8% or 20% plus 3.8% due to this extra tax aimed at investment income. For most listeners, NIIT might not apply, but I mention it so our high net worth friends are aware of the full tax picture. Now that we understand the types of capital gains and the tax rates, let's look at real-world examples to see how all this plays out when people actually invest and make decisions. Examples will help ground these concepts in reality. Real-world examples. Capital gains in action. It's time to translate these concepts into real-life scenarios. In this section, I'll walk through a few common situations investors face, and we'll see how capital gains and losses affect each one. Example 1. Selling an appreciated stock. Imagine you bought shares of a company, let's say Apple, a few years ago. You purchased 100 shares at $100 each, so your initial investment, your cost basis, was $10,000. Now it's a few years later, and Apple's stock price has increased to $150 per share. Your 100 shares are now worth $15,000. If you decide to sell all 100 shares at $150, you would receive $15,000. Your capital gain is the difference between the sale proceeds and what you originally paid. $15,000 minus $10,000 equals $5,000 gain. If you held those shares for more than 1 year, which in this scenario you did, a few years, that $5,000 is a long-term capital gain. Come tax time, you will owe tax on $5,000 at the long-term capital gains rate. Depending on your income, that might be 0%, 15%, or 20%. For many average investors, it'd be 15%, meaning a $750 tax bill on that $5,000 gain. If instead you had bought and sold the shares within, say, a 6-month window, that $5,000 would be a short-term capital gain. It would be taxed as part of your regular income. If you're in, for example, the 24% tax bracket, you'd owe $1,200 in taxes on that $5,000 gain. That's a big difference compared to the $750 in the long-term scenario. It highlights why long-term gains are often more favorable. This stock example is very common. Perhaps you invested in a mutual fund or ETF instead of individual stock. The concept is similar. One thing to note, if you reinvest dividends or make multiple purchases, your cost basis will be the total you invested. And if you sell only part of your holdings, you'll realize gains on those shares sold. Investors often use methods like FIFO or specific identification to decide which shares they're selling to manage gains, but that's beyond our scope today. Now, what if the stock fell in value instead? Say you bought at $100 and sold at $80 per share. Then you'd have a $20 per share capital loss. If you lost $2,000 total, you could use that loss to offset other gains you have this year. If you have no gains, you can even deduct up to $3,000 of that loss against your regular income. For example, it could reduce your taxable salary and carry the rest of the loss forward to future years. We'll talk more about loss deductions soon, but keep this in mind. Losing investments can soften the blow by saving you money on taxes, which is the silver lining of a bad investment. Example 2, selling your home, primary residence. Next, let's consider something many of us might do in our lifetimes, selling a home. Real estate can appreciate significantly, and your primary home is indeed a capital asset. However, there is a special rule here that's very important. If it's your main home, primary residence, and you've lived in it for at least 2 out of the last 5 years, the tax code gives you a big break. You can exclude up to $250,000 of capital gains from the sale of your home from taxes, or up to $500,000 if you're married and filing jointly. What does this mean? Suppose you and your spouse bought a house 10 years ago for $300,000, and now you sell it for $600,000. That's a $300,000 gain. Normally, a $300,000 gain would be subject to capital gains tax. But since it's your primary residence and you meet the ownership and use tests, live there 2 of the last 5 years, etc. As a married couple, you can exclude $500,000 of gain. Your $300,000 gain is entirely below that limit, so you'd pay no capital gains tax on the sale. That's huge. Even a single person with a $250,000 exclusion would pay no tax in this scenario, because the $300,000 gain exceeds the single exclusion by only $50,000. Actually, a single person would have to pay tax on that $50,000 portion above the $250,000 limit, but the first $250,000 would still be tax-free. This primary home exclusion is a fantastic benefit of home ownership. It essentially means most people can move homes without tax if their gains are below these thresholds. Of course, if your gain is larger than $250,000 or $500,000, any amount above that is taxed as a capital gain. And note, this exclusion typically can only be used once every 2 years. You can't sell multiple homes each with the exclusion in short succession. There are more details and exceptions. For example, if you had to move for a job and sold sooner, there are partial exclusions, etc. But the core idea is that the tax code recognizes the importance of your primary home and gives you a break. So in our real-world example, selling a home often results in no capital gains tax if you meet the criteria, or a much reduced tax if the gain is only partly sheltered by the exclusion. What if the house was an investment property or a second home instead? Then, unfortunately, this exclusion doesn't apply. Those would be treated like any other investment. For instance, if you flipped a rental property for a $100,000 gain, that is fully taxable, likely as a long-term gain if you owned it over a year, or short-term if less. Real estate investors have another trick up their sleeve, though, which we'll touch on in the strategy section: the 1031 exchange, a method to defer real estate gains by quickly reinvesting in another property. But hold that thought. More on 1031 exchanges soon. Example 3, rebalancing an investment portfolio. Our third scenario is one that more advanced investors deal with: portfolio rebalancing. Rebalancing is when you adjust your investment portfolio back to a target mix of assets. For example, you want to maintain 60% stocks and 40% bonds. If stocks had a great year, you might suddenly have 70% stocks and 30% bonds. To rebalance, you might sell some stocks and buy bonds to get back to 60-40. It's a sound investment practice to control risk, but it can trigger capital gains taxes if done in a taxable account. Let's say you have a portfolio in a regular brokerage account, not a retirement account. Over the year, your stock funds grew significantly. You decide to sell $10,000 of your stock fund, which has gone up in value, and move that money into a bond fund to rebalance. That sale of $10,000 might, for example, include $2,000 of profit, gain, and $8,000 of your original investment basis. By selling, you just realized $2,000 in capital gains, which will be taxed. If those were long-term gains, maybe you owe 15% of $2,000, about $300, in tax. If short-term, maybe your rate is 24%, and you'd owe $480. The key point: rebalancing often means selling assets that have appreciated, and thus it creates a taxable event. In fact, one major friction or cost that investors face with rebalancing is exactly this: the capital gains taxes triggered by selling appreciated assets. How do investors handle this? Many will try to rebalance in tax-advantaged accounts first, like in a 401k or IRA, where sales don't incur immediate taxes, or use new contributions and dividends to buy underweight assets rather than selling winners. Another approach is to rebalance less frequently, or only when the allocations drift a lot, to minimize constant trading. Some might accept the tax hit as a cost of managing risk, especially if the gains are long-term and taxed at a lower rate. Rebalancing is a great example of how investment strategy and tax strategy intersect. A purely financial decision, keeping your portfolio balanced, can have a tax consequence, so smart investors always consider both sides. Those were three big examples: selling stocks, selling a home, and reallocating a portfolio. You can probably see yourself in at least one of these scenarios. To briefly mention, other real-world situations include selling a business, which can result in capital gains if you sell for more than your basis in the business. Selling cryptocurrency, yes, crypto is taxed as property, so selling your Bitcoin or Ethereum at a profit will trigger capital gains tax just like selling stock. And even selling collectibles, like art or rare coins, which, as noted, have their own higher tax rate for gains. The principles are the same across these cases, even though the assets differ. With a solid grasp of what capital gains are and some examples of how they show up in real life, let's turn to the proactive part: strategies to manage and minimize capital gains taxes. After all, the less you legally have to pay in tax, the more of your investment returns you get to keep working for you. Strategies and tips to minimize capital gains taxes. Nobody enjoys paying more tax than necessary, and the good news is that there are smart strategies to minimize the taxes on your capital gains. Here are some approaches that investors use to keep their tax bills down. Remember, this isn't personal tax advice. Always check with a tax professional for your situation, but these are generally wise practices. 1. Hold investments for the long term, at least 1 year or more. This is one of the simplest ways to get a lower tax rate on your gains. As we discussed, long-term capital gains enjoy lower tax rates than short-term ones. By planning to hold assets for over a year, you convert what would be short-term, taxed higher, into long-term, taxed lower. For example, if you're considering selling a stock at 11 months of holding, it might save you money to wait that extra month to hit 1 year and qualify for long-term rates. Of course, investment decisions shouldn't be made on taxes alone, but when feasible, a bit of patience can pay off at tax time. Bottom line, trading frequently within a year can lead to higher taxes, so a buy and hold strategy is generally more tax efficient than rapid-fire trading. 2. Use capital losses to offset gains. Tax loss harvesting. If some investments have lost value, consider selling them to harvest the loss for tax purposes. Capital losses offset capital gains dollar for dollar. So if you have $10,000 in realized gains this year, and you also realize $8,000 in losses, your net gain is only $2,000. You'd only be taxed on that $2,000, not the full $10,000. This can dramatically reduce your tax. Furthermore, if your losses exceed your gains for the year, you can use up to $3,000 of excess losses to reduce your ordinary income, a further tax benefit each year. Any losses beyond that $3,000 can be carried forward to use in future years. This strategy of selling losers to offset winners is known as tax loss harvesting. It's commonly done toward year end. Investors review their portfolio, and if they have some big gains, they might sell some underperformers to generate losses to offset those gains. One caution: be mindful of the wash sale rule. If you sell a security to claim a loss, you can't buy the same or a substantially identical security within 30 days before or after, or the IRS will disallow the loss. So harvest losses smartly. Sometimes people swap into a similar but not identical investment to maintain exposure without triggering the wash sale rule. Using losses effectively can save you a lot in taxes over time. 3. Take advantage of tax-deferred or tax-exempt accounts. Another key strategy is asset location. Basically, putting your investments in accounts that give you a tax break. For example, if you hold stocks or funds inside a 401k, traditional IRA, 403b, or other tax-deferred retirement account, you can buy and sell as much as you want within that account without paying capital gains taxes currently. The gains accumulate tax-deferred until you withdraw in retirement, at which point they may be taxed as ordinary income, but by then you might be in a lower bracket, etc. Similarly, in a Roth IRA, your investments grow tax-free, and qualifying withdrawals are tax-free. You never pay capital gains on Roth investment growth if rules are followed. By contrast, in a regular taxable brokerage account, every time you sell and realize a gain, that could be a taxable event that year. So, a smart move is do more frequent trading or rebalancing inside tax-advantaged accounts, and try to hold long-term positions in your taxable accounts. For instance, rebalance your portfolio within your 401k instead of your taxable account, if possible, to avoid triggering taxes each year. Also consider health savings accounts, HSAs, or 529 college savings plans for certain goals. They also have tax benefits. HSA investment gains can be tax-free for medical expenses, 529 gains tax-free for education. The idea is to shelter as much of your investing activity as possible in accounts where Uncle Sam can't touch the gains, at least not immediately or ever. Be mindful of when and how you sell assets. Timing can make a big difference. If you have control over when to sell an investment, consider the timing relative to your overall income and other events. Sell in a low-income year. If you know your income will be lower in a certain year, say you're between jobs or just retired or otherwise expect less income, that might be an ideal time to take some gains. With lower overall income, you might even qualify for the 0% capital gains rate on some of your long-term gains. Strategic timing could save you a chunk of tax. Spread out sales. If you have a very large position to liquidate, you might not want to sell it all in one calendar year, which could bump you into a higher tax bracket for capital gains. Instead, you could sell gradually over multiple years, keeping your taxable gains in a lower bracket each year. donate or gift appreciated assets. If you are charitably inclined, donating appreciated stock or property directly to a charity can be very tax efficient. You typically get a charitable deduction for the full market value, and you avoid the capital gains tax you'd pay if you sold it yourself. Similarly, you can gift assets to family members. If they are in a lower tax bracket, they might pay little to no tax on the gains when they sell, though be careful with gift tax limits and the so-called kiddie tax rules for giving assets to children. These strategies can get complex, but they are worth mentioning as options for minimizing taxes while achieving other goals: charitable giving, family gifts. Step up in basis at death. This isn't exactly a strategy one uses actively, but it's notable. When someone passes away, heirs typically get a stepped up basis on inherited assets. That means the cost basis resets to the value at the date of death. All the unrealized capital gains during the original owner's life can become permanently untaxed. While I don't recommend holding on to investments just for this reason, life is for living after all, it is a factor in estate planning for some. If an asset has a huge gain and you were going to leave it to heirs, holding it until death means they won't owe capital gains tax on that appreciation. Again, not exactly a day-to-day strategy, but an important rule to know for the long-term wealthy investors out there. 5. Use exclusions and special tax deferment strategies when applicable. We touched on the big one for personal residences. Make sure you meet the requirements, ownership and use tests, to claim the primary home gain exclusion if you sell your home. Plan your home sales accordingly. For example, if you have 2 homes and are moving, think about which one qualifies as primary, etc. For real estate investors, the 1031 exchange is a powerful tool. A 1031 exchange, named after Section 1031 of the tax code, lets you swap one investment property for another and defer capital gains taxes on the sale. Essentially, you sell a property and reinvest the proceeds into a new property of equal or greater value, following certain rules and timeframes. And the IRS lets you delay recognizing the gain from the first sale. It's like saying, I'm not cashing out, I'm just moving my investment from property A to property B. If done correctly, you pay no tax at the time of the exchange. The tax is deferred until you eventually sell the replacement property, unless you swap again and again. Some investors keep doing 1031 exchanges and never pay the gain tax in their lifetime. It's important to follow the rules. You have to identify the new property within 45 days and close within 180 days. And it must be like-kind real estate, which is quite broad. It basically means any other real estate for the most part. If you're a real estate investor, definitely be aware of 1031 exchanges as a strategy to legally dodge, or rather defer, capital gains tax and keep your money invested. Remember though, it's a deferral, not a forgiveness, unless, as mentioned, the asset eventually gets a stepped-up basis at death, etc., which can then permanently eliminate the deferred gain. Another special case, opportunity zone investments can defer and even partially reduce capital gains if you roll a gain into a qualified opportunity fund that invests in designated economically distressed areas. This is a bit niche, and the rules have timelines. It was introduced in 2017's tax law changes, so I won't dive deep here, but it's one more avenue where certain investments get preferential treatment on capital gains. Lastly, keep an eye on future tax law changes. Tax laws evolve, and capital gains rules could change in the future. For instance, there have been discussions about adjusting capital gains rates or treating them differently for very high earners. Staying informed through podcasts like this, for example, and consulting with a financial advisor or tax advisor periodically will help ensure you're using the best strategies as laws change. Understanding capital gains and their tax implications is vital for maximizing your investment returns. To recap, capital gains are the profits from selling investments, and how long you hold an asset affects how much tax you pay. We learned that short-term gains, assets held for a year or less, are taxed like ordinary income, which can be quite high, whereas long-term gains, held over a year, enjoy lower tax rates, often 0%, 15%, or 20% for federal taxes depending on your income. We covered a variety of assets: stocks, bonds, real estate, crypto, collectibles, all of which can trigger capital gains taxes when sold. We also discussed capital losses and how they can be used to offset gains. Remember the $3,000 annual deduction rule and carrying forward excess losses. Special cases like the home sale exclusion and 1031 exchanges offer ways to avoid or defer taxes in specific situations. And importantly, we went through real-world examples to see these concepts in action. Selling stock, selling a home, rebalancing a portfolio, etc., each with its own tax considerations. By planning ahead and using the strategies we talked about, holding investments for the long term, harvesting losses, utilizing tax-advantaged accounts, timing your sales wisely, and taking advantage of exclusions and exchanges, you can significantly reduce the bite of capital gains taxes on your hard-earned investment profits. Every dollar you save on taxes is a dollar that stays invested and compounding for your future. As we wrap up, here's a final thought. Managing capital gains is just one part of a holistic financial plan. It's important to balance tax strategies with your overall investment goals and personal circumstances. What's right for one investor might not be right for another. That's why I encourage you to review your investment portfolio and tax strategy with a qualified financial advisor or tax professional. They can provide personalized guidance, ensure you're taking advantage of the latest rules, and help you make decisions that align with both your financial goals and tax efficiency. Thank you for joining me on this journey to understand capital gains in episode 13 of Mastering Finance. I hope you found this discussion clear and informative. By being aware of how capital gains work and planning accordingly, you're taking an important step toward mastering your finances. If you enjoyed this episode, or if it sparked any questions, don't hesitate to reach out or consult with your advisor for more details. Until next time, stay informed, stay invested, and keep mastering your finances. Thanks for listening, and I look forward to catching up with you in our next episode.